Hello, welcome. Thank you so much for joining us for the first of our webinar series for the fall of 2021 about tax law changes that you can anticipate in 2022. We are delighted that you're here, and we have our resident expert, Neal Myerberg, on deck, getting ready to enlighten all of you with the kinds of changes that you can make or steps that you can take to maximize your tax advantages and support the charities that you love. We certainly hope that Friends of Yad Sarah will be near the top of that list. My name is Adele Goldberg. I represent Friends of Yad Sarah for the United States. As I think most of you know, Yad Sarah is Israel's largest volunteer staffed organization, best known for lending out durable medical equipment. Wheelchairs, canes, crutches, hospital beds, oxygen concentrators, breast milk pumps, almost anything that you need to go home from the hospital and recuperate, or in some cases receive palliative care at home among family and friends in your own community. But the organization also has about 20 other services on the continuum, such as accessible transportation, in-home geriatric dental care, legal services for the impoverished elderly, day rehabilitation services in 5 locations, outreach to the homebound, emergency alarm response systems, and about a dozen more. So we thank you so much for your support of the organization, because without all of you, we wouldn't be able to do as much as we can do for the people of Israel. And without further delay, I'd like to turn this over to Neal Myerberg. Thanks for joining us, Neal.
Thanks, Adele. Let me introduce everybody to the program. It's really interesting. I've been making this presentation off and on for a while, and things change every day, every week, every month. We know a lot more than we did back in the fall, early fall, but we still don't know very much. So what I'm going to try to do is to walk through some of these concepts with you. The title, What to Expect with Tax Law Changes in 2022. A bit of procedural discussion. Feel free to ask questions anytime. Don't have to wait till the very end. And if you're going to ask questions, would you please type them into the Q&A box, which you'll see indicated on the bottom of your screen. And Adele will see those questions and she'll field them for me. And we can perhaps, by that means, be able to deal with questions on topics at the moment that we're discussing. So what to expect with tax law changes in 2022. And the interesting question asked of me is, do we know what will happen in 2022? And the answer is no. We have some indications from the Congress, from the House of Representatives. We have indications, of course, from the president, what he's been campaigning on, but we don't really know, but we have some sense of it. We'll talk about that in this presentation. We're going to talk about what it may be. I can't say what it will be, but I can kind of lean to things I think are going to happen and some ideas to deal with them, if not in 2021, at least in 2022. So you can see on this screen that the campaign pledge of the President Biden when he first took office was to change the tax code, put higher taxes on wealthy households and on corporations. And also, for many of us, this is also interesting and maybe troublesome, overhaul the way wealthy families, and we don't know what wealthy families mean anymore in terms of the numbers, how they transfer assets to heirs. The tax law changes that were proposed include raising the top individual rate to 39.6, that's about almost a 3% higher rate, extending the Social Security tax portion for earnings over $400,000, which means that's the number that it will still be assessed 12.4% against. Used to be $137,007. That's pretty consequential. And for real consequential discussion, raising the capital gains rates to 39.6 for taxpayers over a certain leverage. Maybe most of us don't have $1 million in income, but we're not real sure whether when this is finally enacted, there might not be some step ups to 39.6. Maybe for taxpayers at $400,000, there'll be also some capital gain rise. At $200,000, $300,000, probably not. But we don't know, but we do know there is a lot of talk about changing capital gains rates. Wealth taxes, estate tax overhaul is what we have to spend some time thinking about. Overhauling taxes around wealth transfers essentially means that passing assets generationally, other than to spouse, can be more expensive now, and more expensive from a number of tax perspectives. You can see in bullet point number 2, the proposed elimination of the step up in basis. Now, let me explain that. You may all know what it is, but let's talk about it for a moment. When someone passes away and leaves assets that were appreciated in that person's ownership, like stocks, real estate, works of art, to an heir, the heir takes the asset at its value at date of death as the heir's basis. And if the heir then sells the asset, the capital gain is measured from the basis at date of death to the time of sale. If you eliminate the step-up basis, the heir takes the capital gain basis of the donor, the testator, the deceased person. So that person bought Apple stock at $20, and now it's worth considerably more. That asset gets transferred to the next generation with a value for tax purposes of $20. And the sale of it at that point, and it's extremely large, between $20 and the present value, that capital gain would be taxed. That is very, very consequential and something we've been watching very carefully. There is some indication that there has been some cooling of that, but it's still there. It hasn't changed yet. And on the bottom bullet point, you can see that the present gift and estate tax exempt amount of $11.7 million, double that for a couple, married couple, that transfer fee, that free transfer amount of $11.7 million could be severely reduced by 2022 to $3.5 million. Still not an insubstantial number, but certainly not $11.7 million. And we don't know whether this number is going to be portable so that both people have 3.5. The unused portion going to be okay for the survivor? We don't know that. And for lifetime gifts, I'm not talking about the annual exclusion of $14,000 or $15,000 per person, but lifetime total gifts will be capped at $1 million. And finally, the tax rate for anything in excess of $3.5 million in estate assets or $1 million in giving will be taxed at 40% or higher. This one bullet point has a great deal of consequence in estate planning. And so we have to put this in context as we look through the rest of this presentation about what this will mean and how this is to be dealt with. Here are the proposed changes. I know it's a lot of words. You're welcome to let us know that you'd like to have this slide, this presentation, and we'll be happy to send it to you. But you can see the proposed changes, the Biden side and the House Representative side. On the Biden side is what we said before, 39.6 rate for taxpayers, higher Social Security tax base, capital gains rate, and that could be double for wealthy investors. On the House side, they would still raise the top rate to 39.6, but they would create a surcharge, and this would be above $400,000, and they would create a surcharge on what we call modified gross adjusted income that would be above $5 million. But for trusts above $100,000, all important stuff, trusts, grantor trusts, for example, they would be based on 3% of everything above $100,000, not above $5 million. And so these are the differences, not considerable, between what the House is saying and what the administration is saying. This is interesting also. Don't forget, the Biden plan was 39.6 for a capital gain rate for people over $1 million in income, raising it from 20%. The House plan raises the long-term cap gain rate only to 25%, but establishes a new surcharge on incomes above $5 million. There is also net investment income tax. The whole point is, in the House side, the top federal marginal cap gain rate could reach 31.8. On the administration side, it could reach 39.6. So there is some trading. We know there's horse trading going on in the Congress. The administration just had the bill passed for infrastructure. There's the Build Back Better bill that's now going to be contemplated. There are tax provisions in both of those bills, but it's not purely a tax bill. This, what we're talking about now, will be part of a pure tax bill unless it's put into these various other legislative pieces where each of these things takes a role in that. We just don't know yet. On the bottom, on the left, The Biden plan would reduce the estate tax, gift tax exemption from 11.7 to 3.5, as we talked about. We should remember now, if nothing's done, if no laws change, the Biden plan doesn't come into effect and nothing changes, in 2026, the law sunsets that now exists, and the exempt amount will be $5.6 million, not 11.7 or whatever it gets to by inflation from 2022 to 2026, but also with a top rate of 55% tax. This means, in plain English, if nothing happened, if we weren't having this conversation, for those people who pass away in 2026 or thereafter, the exempt amount is going to be $5.6 million. Anything in excess of that, we taxed at 40%.
Wow.
One doesn't know how much one's estate is when you think about it. Your home, a life insurance policy, your IRAs, your 401ks, your personal investments, your second property maybe. Before you know it, with values that they are, $5.6 million is staring at you. On the house side, they would go from not $3.5 million, but a little bit over $6 million in the unified estate tax credit. But the
Neal,
house.
we have a question.
Let me finish this
Somebody
one.
would like to know if this presentation is relevant only for wealthy folks or also for quote unquote normal people.
It's going to
So
come.
how does,
We're going to be doing normal people. I'm just showing you the worst scenario for certain people. And it's a good point. We're going to go into much more practical things in just a moment. The final thing, even for regular people, if you're leaving assets in your estate to someone who survives you other than a spouse, the step up in basis is really, it really has to create a penalty, regardless of the value of your estate. If you're passing a home to your children that you have limited basis on, and that's in the estate transfer to them, and they sell that home under the Biden plan, they will be taking tax as if you sold it yourself before you died. Your basis. House plan, no step in basis. Same thing happens here. A real difference here between the House plan and the Biden plan, which makes us think that maybe the House plan is a more relevant plan. No step up in basis, no tax on the step up for the surviving spouse, no front-end capital gains taxes if you create charitable vehicles, and the issue of valuation rules for those people on the call who have ownership of LLCs or personal corporations in which they're funded with stocks or other assets. There will be no valuation breaks when they're counting them in terms of your estate planning. So these are things to think about globally. But let's talk for a moment about what would happen to regular people. In the light of the changes, what should people do? And I don't know what high net worth families are, but let's think about it for a moment. Any of you, if you have the need for this estate tax credit and it worries you that it's going to go from 11.7 to something lower in 2022, maybe in 2021, do some transfers to heirs of property they would otherwise inherit to them directly or using trusts. It's already mid-November, may be difficult. And since we don't know whether it's going to be reduced considerably, you might not want to do this, something to think about. Number two, those of you who have opportunity to accelerate income in 2021, maybe you could be paid a bonus, maybe you got some deferred income, maybe you can just liquidate some assets to get income. The tax rates for your income on 2021 will be lower than tax rates for your income in 2022. Those of you who may be worried about what capital gains will be like in 2022 may want to take some gains in 2021. You'll pay lower tax on those gains, or you can give some of those gains by transfers of the assets themselves. The charity, as you know, stocks given to charity to make charitable contributions are given to charity at their full value with no tax on the gain on your contribution. This last part, using trusts for succession planning, we'll talk about in a moment. How do you deal with the limitation of step up in basis? That's the whole point of this. If you use appreciated assets for charitable giving, you avoid tax on gain. The step up in basis is irrelevant. If you create a charitable remainder trust with appreciated assets, we'll talk about that. It's a very useful tool for those of you who are trying to find ways to do retirement planning. With appreciated assets, you pay no tax on the gain when funding the trust. And if you have works of art or collectibles that you want to make a gift to charity, you will pay no tax on the gain as well, although you won't have much valuation or deduction, because unless you give a work of art to an institution that uses it for its exempt purposes, it only is deductible at your cost. The CARES Act, much more fundamental. For 2021, those of you who make charitable gifts to Yad Sarah and others who don't itemize deductions should know that if you gave at least $300 per person or $600 per couple in 2021, you can deduct them as charitable contributions even if you don't itemize. So those of you who have made your gifts already or are about to realize that that $300 deduction or $600 deduction will save you some taxes. Number two, if you are going to itemize deductions in 2021 and you make gifts of cash to charity, you can deduct up to 100% of those gifts against your adjusted gross income. That's important because sometimes people's adjusted gross income is low because of how they get their income, and the charitable contributions can't be deducted in the year of the gift in full. They have to carry them over. With this rule, only for 2021, you can deduct your cash gifts to charity up to 100% of your adjusted gross income. And lastly, for many of you who've done this, and some are thinking about this, if you make contributions in 2021 to establish a charitable gift annuity, for example, and you use cash to do it, it's a cash gift eligible for deduction up to 100% of AGI, which may give you a reason to itemize your deductions instead of taking the standard deduction. This is from the CARES Act. This is law. This is not what we think may happen. This is what actually is in the law now. Now, something for all of you to think about, and it really has nothing to do with tremendous wealth. It has to do with how you're planning for your family. There was law until recently. If you left an IRA, we'll call it an inherited IRA, to the next generation of your family, they took the IRA with the right to draw money from it, the required minimum distributions based upon their life expectancy. And they would only pay tax on the amount they had to withdraw. So they could stretch it out, 26 years, 25 years, 30 years. And that made it easy for you to plan for them because you knew that they would have money considerably deep into their own maturity, their own retirement, and also pay less tax as a consequence. Now the law has changed. There is no more stretch IRA for those you would normally leave it to. There are some exceptions, a spouse being one, but a stretch IRA is virtually over for most individuals. So if you own an IRA and you want it to go to children, you've got to find an alternative plan because you really would rather the children get the benefit over life or lives and not just over 10 years. And that brings me to the topic which you ought to bring to the attention of your planner this year about using a charitable remainder trust or a charitable gift annuity end of lifetime, to provide income for the life or lives of your children measured by their life or lives and not limited to 10 years. By doing that, you have the entire value of the IRA available, now in the form of a charitable trust, to pay income for the children at a stated amount through all their lives, with the remainder at the very end, which will be many, many years and decades hence, being transferred to the charity. But during the course of the period of the trust, the children will receive payments of income in the fashion you wanted them to over the lifetimes. These are known, as you see on the bottom, as testamentary life income gifts. And if you're doing it through an IRA, and we have been doing this often now for various individuals and their planners, your beneficiary designation in the IRA is, it shall be paid over to my charitable remainder trust at the end of my lifetime. Your planners can do that. And a shell charitable remainder trust document is prepared, unfunded, means nothing, till after your lifetime, when the assets in your IRA are paid over to the trust, if that's what you decide to do.
Neal has just thrown a lot of information at all of you. Does anybody have any questions so far? Okay, Neal.
Okay, I'm sure questions will arise. The exceptions to the inheriting IRA rules, your surviving spouse is an exception, doesn't govern by the 10-year rule. A minor child, but not a grandchild of the original owner, 10-year term applies until the child reaches 18. That's a rare scenario, but possible. If the beneficiary of your IRA after you is less than 10 years younger than you, it doesn't apply. And there are special provisions for those individuals who would inherit your IRA who are disabled or chronically ill, and that's all defined in the statute. You need to pay very close attention to the new rules about IRAs, which govern 401ks and 403bs and all kinds of qualified plans, because it's upsetting the plans of many people that would have their children receive the IRA throughout their lifetime. This slide sort of talks about something that we've all been contemplating. That is, where's interest rates going to go next year? Well, my first header, which I began to write in October, is interest rates may rise in 2022, but not substantially. Not that they may rise now. It's almost clear they will rise in 2022. The Fed has made it very clear that in order to slow inflation, interest rates have to rise so that becomes more difficult to borrow and therefore keeps more money out of the system, and therefore it fights inflation. That's what the concept is. The Fed also has decided, not just indicated, but has decided to slow the purchase of assets like treasury bonds, which support the economy. They did that knowing that keeping those that way might keep interest rates down. But the fact is, if they're not going to buy these bonds anymore and put money in the economy, interest rates will rise. Formal announcement did in fact come in November. Number three, the discount rate, the IRS discount rate, which is based upon the rates for midterm treasuries, is still low, 1.4% for November. This is important for calculations in estate planning, calculations for annuities, calculations for grantor trusts. The rate is low, which particularly impacts annuity rates for individuals under age 70. 70 plus, the rate is not a burden. But as interest rates go up, as treasuries go up, that 1.4% will also go up. Look, the whole concept of having higher interest rates means it's going to be more expensive to borrow. Interest on credit cards will be higher. There would likely be, we expect, some more interest paid, obviously very little paid now, on money markets and CDs. So it's a kind of a balancing act. You can get more money on your cash investment, but it's going to cost more money to maybe charge credit cards unless you pay them off every month. If you have an adjustable mortgage, it may affect that. So this is kind of a balancing act, but there is unfortunate inflation right now, and the Fed's going to have to take enough steps now to keep inflation lower so that people's money, which is now being spent at levels not seen for several years, can actually buy the goods they want and not overpay for them. And I'm saying on the bottom, taking risks with cash to retain an additional return. What would you buy? Low-rated bonds, any things that pay high rates. It may be something to think about not doing, particularly if you're older and particularly if you're retired. Having fixed income, having payments that are dependable, even though not adjusted by inflation, may be the trend now because people are going to be concerned about the volatility of interest rates moving forward. I want to talk about something for a second for those of you who are looking to pass kind of assets like real estate, things like that, to the next generation. Passing assets that are valuable to your children or to your grandchildren, which is skipping a generation, is a very expensive proposition, particularly if the assets are valuable and your basis is very low. If you gift them to them, you can use your exemption amount and then they can take it, but they take it at your basis. So there's something called a charitable lead trust, which allows you to do the following. Just for conversation, we're talking about this. It may not be relevant, but it's something to think about the logic of it. If you're a regular giver to charity over the years in a certain amount, and you intend to continue making that gift, and perhaps you make that gift from income generated from assets you own, like a piece of real estate, your investment real estate. If you put that real estate into a charitable lead trust for a number of years, it's part of the calculation. Pay your charitable giving from that trust, which is in effect paying it from that property. But if providing the trust, that property is going to go to your children at the end of a term of years, it may well be that you'll be able to pass that property to your children at no gift and estate tax cost. It's something to ponder for those of you who are contemplating working with your planners to figure out how I can do what they call succession planning. How do I move assets from generation to generation It's more difficult now with IRAs. It's getting more difficult now with appreciated assets, the step up in basis, the higher state tax rates. Very important conversation to have with your planner. And I would hope that you're seeing your financial tax or estate planner at least annually now that these laws are changing so much, because laws are really going to go through a real topsy-turvy period in 2022. Fortunately, and I think it's fair to say, there won't be a clawback to 2021, so that whatever happens in 2022 will likely be the law from that point on, not retroactive. So that's to be taken in consideration when you look at the next year. What is a charitable gift annuity and how does this work? And this is maybe something relevant for many of you. Many of you have done this, have known about it. And why is this so important now? Because having an annuity and getting fixed rate for life and taking the risk out of your quote investment unquote, particularly at retirement or older age, is really a strategy that ought to be pursued. This is something that is very fundamental. And fortunately, this is something that's regulated by the state of New York and other states so that you get a lot of protection for doing this. Charities have to be qualified. They have to receive permission from the state to do this. And as a consequence, we have this law pertaining to many charities in the state of New York, including Friends of Yad Sarah. So let's take a look at this. An individual, male or female, makes a gift of cash or publicly traded securities to a charity in exchange for an annuity. And there's a value placed on the annuity. We'll show you the calculations in a moment. At the end of the term of life of this person or two people, whatever remains, called the residuum, goes to the charity. There is no cash surrender value. Those people will say to me, I'd like to do an annuity, but suppose I need the money in 10 years, I need the capital. Well, you don't do a charitable gift annuity. You know, very many annuities have the problem. You can't do them as well. But in this case, this charitable gift annuity is based upon life or lives with a tax deduction and fixed payments. So let's take a look at some of the fundamental rules about charitable gift annuities. Number one, you are your age to your nearest birthday. That's important because when I meet with people and they ask for calculations and they say how old they are, I always ask them what their date of birth is, because if their date of birth is such that within a short period of time, they will be within 6 months of their next birthday, or maybe they're already within 6 months of their next birthday, they are their next age. And why is that important? They get a higher rate. Number two, if there are two lives involved, this is a concept that is based upon mathematics and actuarial mathematics. If there are two lives involved, the gift annuity rate for two lives is always lower than the rate for the younger person. Why does that make any sense? If one person has a rate of 6.5%, the younger person, and the other person has a rate of 7.1%, why should the rate be lower than 6.5%? Because the actuaries say when you measure something by two lives, the two life piece will run longer than one life piece for either individual. The assumption is that joint and survivor lifetimes are longer than the lifetimes of each one of them individually. So therefore, the rate will always be lower for the younger annuitants. Number three, even though you may use stock to buy a gift annuity, and the stock is appreciated in value, you get the annuity based upon the full value, but some of the capital gain in that contribution, not the whole gain, but some of the capital gain based upon calculation mathematics will be taxed in installments in your annual annuity. So your annual annuity with a capital gain annuity would have some ordinary income, some capital gain income, some tax-free income. Using cash, you have some ordinary income and some tax-free income. You have no capital gain income. Using cash, you get much more tax-free income. That doesn't mean it's a bad plan to use capital gain stock, just something you need to be aware of. And lastly, even though the tables say the life expectancy is 20 years, for example, if one lives or the couple lives past 20 years, payments continue, same annuity rate, continues on for life or lives, it doesn't change. So this is the fundamental question about charitable gift annuities. And as long as you understand them and know that the annuity can be current or deferred, and if you fund your annuity with IRA or other qualified plan contributions, you pay tax on the money taken out of the IRA. I need to step back for a moment. There's no slide for this, but it's something everybody needs to know, and most of you do know. Anyone on this call who is over the age of 70 and a half or 72 in many instances has to take required minimum distributions from IRA, KEO, 401k, 403b, any qualified plan. It has to be taken by a certain date. This date, for example, this year, by the end of this year. Many of you already taken those distributions, but if you haven't, and you want to save some tax dollars on the ordinary income tax that would be charged for those distributions, transfer some of them directly from your IRA administrator to make your charitable gifts. It's called the IRA Charity Rollover or Qualified Charitable Distributions. Any of your RMD that you have sent directly to charities, either as an outright gift or a capital campaign gift or an endowment gift or gift for a certain program or purpose, any of those dollars sent to charity from your IRA will not be taxed on your behalf as receipt of income. You don't get a tax deduction, but you do not pay income tax on it. It's like having another 2020. Last year, none of us were required to take our RMDs. That was an off year. It was a nice year for those of us who didn't have to take them and didn't have to pay tax on them. But we're back to 2021 now, and thereafter, RMDs are required. So look at the IRA charity rollover. You cannot do the IRA charity rollover to buy a charitable gift annuity or create a charitable remainder trust or a donor advised fund contribution excluded by law, particularly because you're getting a benefit beyond merely avoiding the tax on the withdrawal. And lastly, we understand the rate for 2 life annuities, but we should understand that a deferred annuity means if you create the annuity today, but you decide with a charity you're going to take your payments some years hence, the rate is based upon the deferral period, and it's much higher than you would get if it were a current annuity. I'll show you that in just a moment. Here's an example of a charitable gift annuity for an individual age 75, male or female. $10,000 contribution, the general minimum for most charities. Individual age 75 has life expectancy of 12.4 years. This is a table and a discussion based upon Yad Sarad's rates. The tax deduction for making a contribution of $10,000 to create an annuity at age 75 that pays 7.1% for life is almost 25% of the amount you're contributing. So let's look at this summary here. The purchase price is $10,000. The annuity rate for a 75-year-old is 7.1%. He or she would get paid quarterly, semi-annually, or annually at $710 a year. There's a tax deduction calculated, as you can see above, for almost $2,500. That deduction, if you itemize, and your itemized bracket is 25%, means that if you do itemize, that deduction should save you $614 in income taxes, which in effect means your $10,000 annuity is actually only costing you $93.86 because you're saving this money in taxes. That $93.86 return on a payment of $710 means you're getting 7.6% against a contribution. And what's important in this, and what will follow in each page, and why this is so compelling, is in addition to the high lifetime rate, 85.7% of this payment annually for 12.4 years is tax-free. Now, this thing changes month by month. So if you did this next month, or if you have done it months before, this might not be as high, but it's all in the 80 percentile. So when you do a calculation, you ask for a calculation at no risk or obligation, one of the things you're going to find out is not only your rate, thus your lifetime payments, and your tax deduction if you itemize, but how much of your payment each year is tax-free. When this person gets a 1099-R at the end of the year, it'll say that 14.3% of it was taxable, 85.7% of it was tax-free. That's what the 1099 shows. Example number 1, donor, age 75, 1 life.
Okay, Neal, take a breath.
Yes.
This is a lot of information and we're going through it relatively quickly, but I just want to reassure everyone that if you would like to receive an illustration based on your date of birth and the amount of gift that you are considering, whether it's for an immediate gift annuity or a deferred gift annuity, we can provide that illustration for you with no obligation to proceed. It's an illustration that we can send you. You can discuss it with your financial advisor or family member, and then let us know if you'd like to continue with the program.
Should be noted that, and I said it earlier, these programs are regulated by states. And the two most highly regulated states are New York and California. Other states that are regulated include New Jersey and Maryland, Arizona, Washington, Hawaii, partially in Florida, but these are regulated by state laws. Because Friends of Yad Sarah, like many national Jewish organizations, is based in New York, it's governed by New York law, which is good because New York law requires that the charities create a segregated reserve account like an insurance company that's only available for payment of annuities. It's reviewed each year by the state of New York to see if it's sufficient. There is a surplus required above it, has to be held by a trust company. There's all kinds of protections so that if a charity does in fact go out of business, likely with Friends of Yad Sarah, for example, there is a separate fund available to pay annuities. The state of New York is very rigid about that. Let's assume you're living in another state that is not regulated. And you wonder, can I buy a gift annuity? Am I not taking risk? Because in a state that's not regulated, I have no protection like that. What do I do? Well, fortunately, if you acquire a gift annuity with a charity that is regulated and based in New York or regulated in New York, even though not based in New York, and New York law applies, then whether you're in a state that's regulated or not, the gift annuity is going to be governed by the stringent laws of New York as to how the annuitant is to be protected, including the reserve account, the review of the reserve account, the surplus, and the fact that a reserve account can only be used for annuity payments and never be used by the charity otherwise. So I caution you and urge you that if you consider a gift annuity, find out from the charity what rules govern. And if you're doing it with Friends of Yad Sarah, you can be confident to know it's being based upon New York law. In this example, I just wanted to show something that deals with capital gain property. Remember I mentioned before you can use stocks. In this case, the same $10,000 is being attributed by the same age person, the same life expectancy, with a cost basis of $4,000. It means there's a $6,000 gain in the stock being attributed, but it's being contributed as stock. Charity will sell the stock, generate the cash to put into the reserve account to pay the annuity. So much of these numbers are the same amount, $10,000, the same lifetime rate, 7.1%, the same annuity, the same tax deduction, the same tax savings, the same net cost, the same effective rate. Here's where it differs. The tax-free, the ordinary income portion, as I mentioned on the prior screen for the same person, is 14.3%. But in this case, some of what have been tax-free income on the prior screen is now going to be taxed at capital gain. So when you get a 1099-R in this scenario, end of year, it will show 14.3% of it is taxed at ordinary rates, 51.4% taxed at capital gain rates, and 34.3% taxed without any tax as a tax-free portion. Why is this the case? Because a gift annuity, unlike an outright charitable gift, involves a purchase. You're purchasing an annuity for a charity, and under the tax rules, the purchase price portion, not the charitable giving portion, is a taxable event. But since you're doing it through an annuity, the tax is paid in installments, much softer than paying it in one sum, over 12.4 years in the annuity payments reported to the government. So the question is, do you use a gift annuity with cash or with appreciated property? It can go either way, particularly if capital gain rates stay hopefully low. Number three, 2 lives to prove the point. Here's 2 individuals, ages 82 and 80, with rates for age 80 of 8% and 82, 8.3%, if I'm not mistaken. These 2 people say to the charity, to Yad Sarah, we want to contribute $10,000 to buy a 2 life annuity. Now, I find this interesting. The life expectancy of a 75-year-old is 12.4%. Life expectancy of 2 people, ages 82 and 80, both older than 75, is 12.1%. The actuaries think that these 2 people together will live nearly as long as a 75-year-old will live individually. It is what it is, folks. This is what the mathematics say, and we have to use the math in doing our calculations. So in this case, there's a $10,000 contribution for 2 lives. And look at this. The rate for 2 lives, 82 and 80, is the same as the rate for one life, age 75, because the life expectancies are almost identical. As the tax deductions is almost the same as a 75-year-old. It is that way because of the life expectancy table. So they've contributed $10,000. They're giving a rate of 7.1%. Same amount if they were 75 single life. Tax deduction similar. The tax savings, if they itemize, almost the same. Their effective annuity rate is almost the same. Even the tax-free portion is almost the same. Proof of the point is that older individuals will have a lower rate than each of them individually. So you may argue, well, why don't we just have one annuity at age 82 for 8.3%, and the other person will take one annuity at age 80 for 8%. Good idea, except that as each person passes away, that annuity is over, and the second person doesn't get paid on that annuity. So the question is, do you want an 8.3 and an 8.0? Each one ends, it's over, or you want 7.1 that'll run for both lifetimes. In this case, this example has it run for both of their lifetimes. 3 examples so far. One life, age 75, one life, age 75, giving stock instead of cash, and 2 lives, ages 82 and 80, giving cash. Look at the similarity between the 75-year-old and these folks. Now, I've done gift annuities for people who are uncles and nephews, parent and child, but the child's age or the nephew's age or the niece's age can't be below 60 to make the annuity mathematics work. So I did one a year or two ago for an individual, an uncle age 91, nephew age 60. The rate for age 60 was going to be 5.7%. Uncle was going to get paid for his lifetime, and if the uncle predeceased the nephew would be paid for his lifetime, but the rate would be 5.7 for uncle and nephew. Uncle didn't care because he wanted to be sure the nephew would have payments for life or lives, recognizing that the nephew was young and his life expectancy was going to be almost 25 years. So it works. The math depends upon when you're trying to plan. Now, suppose you're younger, you're 60, and you say, I want to provide some support for Yad Sarah, but not to take effect to the future. And I want to start providing for myself because I expect to take my required minimum distributions at some point, 72 perhaps, and I expect to draw my Social Security around age 70. So maybe I can find some more retirement income that I can depend upon. So this individual, male or female, goes to the charity, goes to Yad Sarah and says, I want to contribute $10,000 now, but I don't need my annuity until age 70. So if I do it at age 70, I'll get a tax deduction now, and I get a rate fix, correct? My life expectancy at age 60 is nearly 26 years. Charity takes the $10,000, checks the tables out, and finds that the rate will be 8.2% for the individual when he or she begins to be paid at age 70. That means that that individual will receive $820 a year for payment, as you can see here. The tax deduction is very small because it's deferred, so the tax deduction's a little better than 10% of the value of the contribution. But if you don't itemize, it doesn't matter. What does the tax savings doesn't matter either. But what's important also to remember is that at the time this person reaches age 70, you reach age 70, and you start receiving payments of $820 a year based upon your contribution now, 68.3% of it will be paid tax-free for your lifetime. The reason why the tax-free portion is lower in these scenarios is because of the deferral period. And that's just based, again, upon math. We know all this because we use software that IRS has approved that, in fact, gives us all this information. The bottom part I want to mention to you, and it's maybe hard to contemplate, when you do a deferred gift annuity, you can do a flexible deferred gift annuity, which means that you can do a gift annuity with a schedule of payments that will run from your expected retirement age 70 for 15 years to age 85. So that when you get close to age 70, you have this option. You can do nothing. Your payments begin at $820 a year at age 70, or you can say to the charity right before it's time to get those payments, I prefer having my payments begin at age 80. And the Schedule B of your gift annuity says exactly what those payments are going to be at age 80 or at age 76, 77, 78. You can make a good decision then. Maybe you don't need that money at the age 70 rate, but you rather have that money at the age 80 rate when you turn 80, deeper into your retirement, this is your option in what is called a flexible deferred gift annuity. Any questions or comments about gift annuities, knowing that they're secure, knowing that they're regulated by highly regulated states for Yad Serah, knowing you can use cash or appreciated securities, knowing you are your age to your nearest birthday, and knowing that there is a segregated reserve account both in the state of New York and a segregated reserve trust in the state of California to protect you in those states and to protect you in states that aren't regulated if you make your gift annuity with a New York charity. That's the general discussion of charitable gift annuities in the context of doing retirement planning now or in the future, or just doing fixed income planning now. Do we know what the interest rates are going to look like in 2022? We do not. Would it be wise to wait to see whether the tables of rates for gift annuities change in 2022? Well, they won't. It's not just interest rates, it's a whole combination of things. It's highly unlikely that interest rates will rise, that gift annuity rates will rise in 2022 or in the future beyond that. So the rates of the charities that you check with now will undoubtedly be the rates in 2022. And you can also find out that some charities have different rates than others. Any questions or comments? Please ship them to Adele. Just a few more things to talk about, and then we'll close. And I should say, before we close, that if you want this outline to go with this data and to see whether there are any new questions that may arise, if you want to ask questions of us off the program, you'll have a direct line to Adele, and she will in fact field the questions after the seminar or dates in the future and ship them to me for response directly to you in confidence and personally off this seminar, obviously. Two last things to discuss, and that is the use of charitable remainder trust. Remember, I mentioned before that financial advisors, lawyers, accountants, estate planners are looking at charitable remainder trust now because of the absence of the stretch IRA. This is a case that isn't exactly that, but it does illustrate how they work. This is a woman we work with, age 75, who held a stock portfolio, not in her IRA, individually owned stocks in her brokerage account worth $250,000 with a cost basis of $50,000. So it was a significant gain in there if she were to sell the stocks. Her financial planner says to her, these stocks create too much risk for you at age 75. I want these stocks to be converted to some things more conservative, some bonds, some stocks that are more predictable in terms of the reaction to the market. So I want you to consider selling these stocks so we can do some reinvestment. And she says to them, if I sell these stocks, I've got a gain of $200,000. And that gain of $200,000, depending on the rate, will reduce my values from 250, the value of the stock, to something considerably lower. So I've already given up a lot of money in taxes for what? To take an opportunity for another asset allocation that may or may not give me more yield? I don't think it's a good plan. Maybe what I should do is do nothing. I'll just keep the stocks. I'll let them work through the market. Whatever they're worth end of lifetime will go to my heirs, hopefully at no estate or gift tax. The third choice is to transfer those stocks to a charitable remainder trust, an irrevocable trust, special kind of trust. And by putting the stocks in that trust, they go in at full value, unreduced by capital gain tax at contribution. By doing that, she can deduct some of this. The tax deduction is considerable if she can itemize of $120,548. A fixed lifetime rate of 5.5%. You may wonder, where does 5.5% come from? It doesn't come from tables like gift annuity rates. It comes from IRS tests that tell you what rate it can be based upon certain rules, a 10% rule and a 5% rule. The rate can never be less than 5%. When I did this calculation, the rate for her would maximize at 5.5%, which means that she would receive $13,750 a year for life. And that's payable to her by the trust, irrespective of whether the trust investments are successful or not. If trust has to use principal to pay her, that's the way it would be. At the end of her lifetime, she's still being paid $13,750, whatever remains in the trust, which is what the assets are worth when she is no longer alive, gets paid to charity, the charity or charities named in the instrument. Why would she have done this? Number one, because she wanted to get the stocks at reduced risk. Number two, having lifetime payments of 5.5% was very satisfying to her because it meant that would be like a lifetime annuity, like a lifetime bond. Number three, capital gain taxes were not due when she made the contribution. And number four, the charity she wanted to support, or charity she might have provided for in her will anyway, but now she's doing it through the trust. The question you might ask yourself is, well, aren't the children being deprived of the $250,000 item? Well, assuming that there are other assets that will go to the children, freeing up this assets to do that, it would be a non-issue. But assuming for a moment that this was going to go to the children, it isn't anymore, is it? True, it's not. But some planners say the following: maybe she should take some of the $13,750 a year she's getting in return from this trust and make a gift of some of those funds to her children, tax-free, or to a life insurance trust for her children, and that those funds be used to pay the premium on a term policy, for example, that will attempt to have as a death benefit something resembling $250,000 for the children outright end of lifetime, over the life insurance trust and the lifetime to pay them income for lives. So what we're doing is we're closing the circle. We're transferring the stocks to the charitable remainder trust. In fact, we're giving them away. We're getting paid income for life, avoiding tax on the gain on contribution, taking care of charity, and using some of the income to provide for the children so they can own a life insurance policy. So at the end of lifetime, this is not in her estate. Life insurance is not in her estate. The children take the life insurance proceeds free of any estate or gift taxes. It's wealth replacement, something that can be done for people who wonder whether I should do this, because by doing this, I'm not leaving the assets to my children. And lastly, the idea of a charitable remainder uni trust. And this again may be applicable particularly to using the IRA, because this has an adjustment feature. In a charitable remainder uni trust, the other one was called a charitable remainder annuity trust, same donor, same life expectancy, capital gains substantial, says, okay, I would like to contribute this also to a charitable remainder trust, but I want to use this type. Because first of all, you get a higher rate to start off with. And number two, every year the trust is revalued, and whatever the value is at the close of the calendar year of this trust is multiplied by 7% for next year's payment. If the trust grows just keeping pace with inflation, the payments grow keeping pace with inflation. In all fairness, if the trust has a down year and December 31 value that year is lower than the December 31 value for the prior year, the next year's payments will be lower. But the belief is, with a reasonable asset allocation and normal performance of markets, even though some markets sometimes perform abnormally, that this will keep pace with inflation and pay more for the donor. So let's say you use this for the children, using your IRA, for example. By having a uni trust, as the children get older, the trust will adjust year by year at the fixed rate. Maybe the rate will be 7 or 7.5. We don't know until we calculate it. But that means that the payments every year to the children may increase to keep pace with inflation. This, as you can see here in line 3, the annual annuity payment for the first year is 7% of $500,000, but thereafter the payments adjust yearly. Complicated in concept, easy in application. Something to talk about as you begin to do your estate planning once we find out what 2022 is going to be all about. Something to contemplate. We don't know the answer. To close, 2022 is going to be a curious, difficult, and awkward year for those of us, you and myself, doing planning for ourselves and sometimes for others. It's going to change perhaps the income tax rates, capital gain rates, estate tax exemption amounts, estate and gift tax rates. Well, there'll be a step up basis. There'll be a lot of things still on the table. There's a lot of horse trading going on right now, and that could all find itself in the Build Back Better bill that will be the next thing proposed by the administration in the Congress. The House is much less aggressive in the tax law changing, and then the administration, and that will be consequential for the final rules. As of now, November 17, November 18, 2021, we don't really know the answer. We've been trying to find it out, watching often for what comes out in the tax planning services and written by people who follow this on a daily basis. I don't know any more than I told you today. I do urge you to think about your planning, do your charitable giving, think about gift annuities, think about those things that make you feel good. That is, things that make you feel good because you do some good in the world. Think about how you're going to provide for your children and grandchildren. Think about how you're going to provide for yourself during the course of your lifetime. And of course, we hope a long lifetime. So Adele, I'm going to come back to you just to say that anybody who wants to contact you, you'll tell them how. And we're pleased that people did attend today. Hopefully they found it useful. So Adele, I'm turning it back to you.
Thank you, Neal. Thank you so much to everybody who joined us today for this important program. Everyone will receive a copy of the slides for your review in your leisure time. And if you have questions, you can feel free to get back to me or to Neal directly to answer any questions that you may have. Anything that you discuss with Neal will be discussed with him in confidence. He may tell me that he spoke with you, but he won't tell me the substance of the conversation. You can request an illustration for any of the options that Neal discussed, like a gift annuity, a deferred gift annuity, a charitable remainder trust, with no obligation to proceed. So if you'd like to see what it would look like for you and a partner, we can do that for you. This is an important source of support for Friends of Yad Sarah and the Yad Sarah organization. And we're very grateful for any consideration that you'll give us in including the organization in your plan giving estate planning. We'd also like to know that when you do join us as somebody who's included the organization with a plan, has named the organization with a plan gift or an estate gift, that we would like to welcome you as a member of our Jacob Circle Legacy Society. And we can and send you a copy of our Jacob Circle News and recognize you by name if you'd like in the Jacob Circle News. And then there are other nice perks that go along with that as well. Anyway, I look forward to being in touch with all of you. I want to thank you for your support and for your attention today. And just in closing, to wish you a very happy Thanksgiving and a happy Hanukkah. Please feel free to be in touch with me directly. I look forward to hearing from you. Thank you again.